Hey everyone, welcome back to the channel. Before you even think about putting your hard-earned money into stocks, crypto, or anything else, there are some golden rules you absolutely must know. So many people jump into investing hoping to get rich quick, but they end up making costly mistakes. Why? Because they skip the fundamentals. Investing isn't just a game of picking winners. It's about understanding how money works and building a strategy for long-term success. In this video, I am going to break down 5 essential rules that will save you from major headaches and set you on the path to building real, sustainable wealth. Stick around because rule number 5 is the one that separates successful investors from everyone else. Alright, let's get into our first and most important rule. Build a strong financial foundation. I can't stress this enough. Before you invest a single rupee, you need to get your financial house in order. Think of it like building a house. You would start putting up the walls before you've laid a solid concrete foundation, right? The same principle applies to your money. So, what does a strong foundation look like? First, you need to clear any high-interest debt. I'm talking about credit card debt, personal loans, or anything with a double-digit interest rate. The interest you repaying on that debt is likely much higher than any realistic return you will get from investing. Paying off a 20% interest credit card is like getting a guaranteed 20% return on your money. It's a no-brainer. Next, you absolutely must have an emergency fund. This is non-negotiable. An emergency fund is a stash of cash, separate from your investments, that covers 3 to 6 months of your essential living expenses. This is your safety net. If you lose your job, face a medical emergency, or your car breaks down, this fund will save you from having to sell your investments at a loss or go into debt. Investing should only happen with money you can afford to live without in the short term. If you're depending on your investment returns to pay next month's bills, you're not investing, you're gambling. When your financial base is secure, you can invest with confidence and a clear head. A small market dip won't send you into a panic because you know your day-to-day life is covered. Build your base first, and then you can start building your wealth on top of it. Now for rule number 2, know your goals. This might sound simple, but it's a step that many people overlook. You need to ask yourself a very clear question: why am I investing? Seriously, take a moment to think about it. Are you saving up for a down payment on a house in 2 years? Are you planning for retirement in 30 years? Or maybe you're aiming for financial freedom in the next decade. Your answer to this question will determine your entire investment strategy. Your goals dictate what kind of assets you should be investing in and how much risk you should be taking. Let's break it down. If you have short-term goals, meaning you'll need the money in less than 3 years, you should stick to safer, more stable options. Think high-yield savings accounts, certificates of deposit, or short-term bonds. The goal here is capital preservation, not aggressive growth. You can't afford to risk losing a chunk of your principal when you need it so soon. On the other hand, if you have long-term goals, like 5, 10, or even 30 years down the line, you can afford to take on more risk for the potential of higher returns. This is where assets like stocks, index funds, and ETFs come into play. Over the long run, the stock market has historically provided much higher returns, and you'll have plenty of time to recover from any short-term market downturns. When the market gets volatile and everyone is panicking, you can look back at your goals and remember why you're in it for the long haul. This clarity is your best defense against fear and greed. That brings us perfectly to rule number 3. Understand risk and your time horizon. Every single investment comes with some level of risk. There's no such thing as a completely risk-free investment that also gives you high returns. But here's the thing, risk isn't necessarily a bad thing. The key is to understand it and make sure it aligns with your personal comfort level and your investment timeline. Your time horizon is simply how long you plan to keep your money invested before you need to use it. As we just talked about, a longer time horizon allows you to take on more risk. If you're 25 and investing for retirement, you have decades to ride out the market's ups and downs. A market crash in your 30s might look scary, but historically, the market always recovers and goes on to reach new highs. Patience is rewarded. However, if you're saving for a wedding next year, you have a very short time horizon. You can't afford to see your investment drop by 30% right before you need the cash. In this case, your risk tolerance should be very low. It's crucial to be honest with yourself about how much risk you can stomach. Don't just jump on a hot stock or a trending cryptocurrency because everyone on social media is talking about it. That's a classic case of FOMO, fear of missing out, and it often leads to disaster. Invest in things you actually understand. If you can't explain what a company does or why you own a particular asset, you probably shouldn't be investing in it. Align your investments with your timeline and your personal comfort level, not with the latest hype. Okay, on to rule number 4, and this is a classic for a reason: diversify. You've all heard the saying, don't put all your eggs in one basket. This is one of the most fundamental principles of smart investing. Diversification is the practice of spreading your investments across various assets to reduce risk. Think about it. If you put all your money into a single company's stock and that company goes bankrupt, you could lose everything. But if you spread your money across 20 different companies in different industries, the failure of one company won't wipe you out. Diversification isn't just about owning different stocks, though. True diversification means investing across different asset classes. This includes stocks, bonds, real estate, and maybe even commodities like gold. These different asset classes often behave differently in various economic conditions. For example, when the stock market is down, bonds or real estate might be performing well, which helps to balance out your overall portfolio and smooth out your returns over time. You can also diversify within an asset class. For instance, with stocks, you can invest in different sectors like technology, healthcare, and finance. You can also diversify geographically by investing in companies from different countries, not just your own. A great way for beginners to achieve instant diversification is by investing in index funds or ETFs, which hold hundreds or even thousands of different stocks in a single fund. Remember, the goal of diversification isn't to completely eliminate risk. That's impossible. The goal is to manage it intelligently, so that a failure in one area of your portfolio doesn't spell disaster for your entire financial future. And finally, we've arrived at rule number 5, the most powerful rule of them all: invest consistently and stay patient. This is the real secret to building wealth. It's not about being a genius stock picker or timing the market perfectly. Honestly, trying to time the market is a fool's game. Even the professionals get it wrong most of the time. The secret isn't timing the market. It's timing the market. The most effective way to do this is to invest a fixed amount of money at regular intervals, regardless of what the market is doing. This strategy is often called dollar cost averaging, or if you're in a country like India, a systematic investment plan or SIPE. By investing consistently, say every month, you buy more shares when prices are low and fewer shares when prices are high. This removes emotion from the equation and builds incredible discipline. This consistent approach unlocks the magic of compound interest. That's when your investment returns start earning their own returns. It's a snowball effect that, over decades, can turn small, regular contributions into a massive fortune. But it only works if you have the second part of this rule down: patience. Wealth is a marathon, not a sprint. There will be times when the market drops, and it will be tempting to panic and sell everything. This is where most investors lose money. They sell at the bottom out of fear, and then they miss out on the recovery. History has shown time and time again that investors who simply stay the course and remain invested for the long term significantly outperform those who try to jump in and out of the market. Trust the process, be patient, and let time and compounding do the heavy lifting for you. So there you have it, the 5 golden rules of investing. Let's do a quick recap. First, build a solid financial foundation by clearing high-interest debt and setting up an emergency fund. Second, know your investment goals to guide your strategy. Third, understand your personal risk tolerance and time horizon. Fourth, diversify your investments across different assets and sectors. And fifth, invest consistently and be patient, letting the power of compounding work for you. If you follow these 5 rules, you'll not only protect your capital, but also set yourself up for steady, long-term growth. You'll be investing with a strategy, not just with hope. Thanks so much for watching. If you found this video helpful, please give it a thumbs up, share it with someone who needs to hear this. And don't forget to subscribe for more smart money videos every week. I'll see you in the next one.